Well, to unpack this and more, and of course, what to expect, I'm joined in studio by Anastasia Aronsa. Okay, so what does this all mean? Talk to us.
So, as you mentioned, we did see CPI figures come in a little bit lower, a little bit cooler than what we would have expected. But however, what was quite interesting is even though that figure came in slightly cooler, we did see the rand react, go a little bit lower, and that's in anticipation of the fact that perhaps it does seal the deal for 50 basis points hikes. However, as we mentioned, tomorrow is the Reserve Bank's expected announcement on that interest rate decision. However, it will be the 10th straight increase. We have seen the Reserve Bank basically increase rates again, and this we have seen at least beginning of 425 basis points so far. It's in an increase of a rate hiking cycle that has started in November 2021. As I mentioned, delivering 425 basis points of tightening, and that is to dampen inflation. And as Unathi mentioned a bit earlier on, the target band is between 3% and 6%, and it has been above that band at least since May 2022. However, to talk to us about the potential long-term effects of consumer inflation and a focus on what we can expect from the SARB, we are joined by John Manyike, who is the head of financial education at Old Mutual. John, thank you so much for your time. As we mentioned, that inflation figure coming in a little bit cooler than expected. Was that in line with your expectations, given some of the trends you've been following on why food prices and inflation have been so high?
Yeah, I must be honest, the inflation number really surprised a lot of people. I mean, against the forecast that it was going to be increasing. But I think when you look at the food inflation, which is starting to moderate, we are seeing the impact on the inflation, which is really good news for consumers. To be honest, I think if it were not for the weaker rand, we were more likely going to see possibly maybe the last hike in this cycle. However, we still do expect inflation to continue to fall, and I think we expect it to fall to around 5%. And so it may as well be that this would be the last one, if the rand also holds. But we know that the diplomatic relations between South Africa and Russia are, of course, also impacting on the rand because of the looming tension between SA and the US, which has an effect on the rand. But certainly, if it were not for the rand, it probably would have been the last one. But we're very optimistic that inflation will continue to fall as it's moderating in the cycle. So we may see inflation fall below 5%. And if that happens this side of the year, it will be highly unlikely that the interest rate will continue to rise in this cycle. In fact, you may be surprised that maybe in the first half of next year, we might start seeing some cuts of the interest rate.
On that note, then, it's quite a good thing that you talked about those blackouts because, some of the central bank statements have indicated that the blackouts are adding about 0.5 percentage points to headline inflation, at least for this year. So given that sometimes the argument tends to be that high interest rates for a low growth economy like South Africa does tend to have an impact, where do you sit on the debate around the manner in which the central bank has been dealing and tackling inflation in order for it not to permeate into other inflation baskets?
I think the Reserve Bank was well within its right to hike the interest rate because their mandate is to contain inflation, and the instrument that the Reserve Bank has is actually the interest rate to contain the inflation. So I think it was important to be more aggressive in the cycle, because you don't want the inflation number to become permanent. So I think it was warranted for them to do what they had to do, but we may start seeing the interest rates fall in the new year. So I think there's some good signs. I mean, certainly because of the food inflation starting to taper down.
So it's quite interesting that you mentioned that you are expecting at least some cuts going into 2024, perhaps the first part of 2024. But if either 50 basis points or 25 basis points is baked in tomorrow, what does that mean for consumers' pockets? Because I can imagine right now it's either you tighten your belt, but how do you do so without compromising your financial plans?
Yeah, look, I think a lot of consumers have already tightened their belt, honestly. I'm just asking myself, is there still more room to tighten the same belt? But the reality is, I think for those who are intending to access more credit, you may want to hold off a little bit or use credit responsibly. Because it's certainly, if you cannot afford the repayments, you don't want to find yourself defaulting and end up having a bad credit profile. So I think you need to really be looking at that. The second thing which I think consumers can do is to actually look at your basket of groceries, because we know the specific things where there are huge increases, like your vegetables at about 23%. We're seeing milk, eggs, and cheese about 14.5%. Inflation, bread, 20%. But yes, certain items are difficult to avoid, but in instances where you know that there's a substitute product or what we call non-name brands, don't get married to expensive brands in this cycle. I think what is important is to be able to have access to healthy food, but certainly don't get married to expensive brands.
Credit demand, I suppose, in an environment like this has certainly been rising as consumers try to make ends meet towards the end of the month. How concerned are you about, higher borrowing costs that could increase that indebtedness, given the environment that we're in, and also the fact that we only might see cuts next year?
Well, it is quite concerning because I think a lot of consumers may not understand really the relationship between the interest rate and inflation and why the Reserve Bank has to hike interest rates. I think we need to really take responsibility to empower ourselves knowledge-wise and financially speaking to understand the financial implications of the decisions that we are taking today, especially in as far as it relates to accessing debt. We need to learn to use debt responsibly. Debt is not a bad thing. I mean, it's because of over-indebtedness, people associate debts with something bad. But there are people who actually use debt to create wealth. So educate yourself financially to understand how to use debt wisely, as opposed to using debt and paying high compound interest to the extent that you cannot afford the repayments and run the risk of losing your assets.
All right, John, let's leave it there. Thank you so much for your time. That is John Manyike, who's the head of financial education at Old Mutual. Well, Unathi, you've heard it, 19.22 to the dollar. So let's see tomorrow what we have.
Absolutely, with anticipation. Nastasia Arendse, thank you so much for that.